Hey everyone, we have a great topic for you today. We're talking taxes, specifically capital gains taxes. Before we get started and dive deeper into this topic, please everyone, if you haven't done so, like and subscribe to the channel. We are really trying our best to boost the popularity here, get out some really great content for you all, some useful stuff that can help you in the long term, save you some money, help just help you in general financially. So hit the like button for us. That's a huge help. Super appreciate that. Subscribe as well for all of the updates on the videos. All right, let's get into capital gains. The Biden administration just surpassed their first 100 days in office, typically serving as a benchmark to get certain agenda items across the table. And with that, they decided to throw out an potential increase in various different types of tax rates, corporate taxes, eliminating the step up in cost basis for inherited assets, and the capital gains tax. We're going to focus on that because, again, we are an RIA firm and we do investments and financial planning for clients, so that is the topic of choice for this video. So capital gains, what are they? Well, when you hold an interest in a stock or a security, maybe it's a house or an interest in a business, and you sell that, you're going to incur either a capital gain or a capital loss. The simple definition here is really just the difference in the price that you paid versus the price that you sold it for, and in the stock example, multiplied by the amount of shares. You can see here on this slide, in this example, we have a 100-share purchase at $30 a share, and they sold that interest at $45 a share in that particular stock. Well, the math is easy, right? You take your sales price of $45, subtract it from the $30 purchase price, and you have a $15 per share profit. Now you multiply that by your amount of shares, which was 100 in this example, and you have a $1,500 capital gain. Easy, right? Well, was it a short-term gain or was it a long-term gain? There's a big difference. Why is there such a big difference? Well, it's the tax rate that you have to pay on those respective gains. You can see here on this particular table, the short-term capital gains rate is actually taxed at ordinary income rates, which can be as high as 35 or even 37+%. Conversely, you can see on this chart, the long-term capital gains get what's called preferential tax treatment. So based on the different group of income that you may fall into, you can pay anywhere from 0 up to 20% for the long term, which is a lot lower than the ordinary income tax rate for some people. One great strategy that I want to point out here is how to reduce your potential tax liability. So you're allowed to offset gains with losses in any given year. You start with your short-term gains and losses and you offset those. Then you look at your long-term gains and losses, you offset those. And then you're left with your net gain or loss for short-term and net gain or loss for long-term. So real quick as an example, let's say you've gone through that process and you have a net short-term gain of $5,000. And now you have a net and you have a net long-term loss of $4,000. Well, you can take that $4,000 loss, offset the net short-term gain of $5,000, and you will only show a net short-term gain, capital gain of $1,000 for that year. So like I said, there's a lot of strategizing that goes into this. There's a lot of planning throughout the year. If you're an active trader, or even if you're not an active trader and you've taken some pretty nice gains off the table, you should look throughout the year at certain positions that are showing loss or that are showing losses, and look to maybe sell some of those positions to realize those losses to help offset your gains and thus save you some money on taxes. You can always buy those back. Of course, there's a limit on that. There's what's called the wash sale rule. I'm actually going to do a little bit more detailed video on some of these tips and tricks on saving taxes, the wash sale rule, tax loss harvesting, the tax loss carried forward. So stay tuned for that video, but for here, we're going to stick with the capital gains. I just want to circle back here on the initial proposal from the current administration. So this is for households and individuals earning $1 million a year or more. There's not a whole lot of people that fall into that bracket. The initial reaction was a quick stock market sell-off, which lasted all of about half a day, but in the following trading session had recovered quite a bit of those losses. So again, it doesn't really affect a whole lot of people. And the other thing that I want to point out here is they did some research on this, and about 75% of money invested in the stock market is actually in pre-tax and tax-deferred retirement accounts. So even when you're buying and then selling and you have gains in those type of accounts, you're not paying taxes on those realized gains in any individual year on the retirement account. So again, between the threshold for the income and the majority of the funds being in these tax-deferred accounts, it's not a huge deal, which is why I think that the market kind of shook off the news within a few hours. But like I alluded to earlier, if you do have a taxable account, whether it's yourself or maybe a joint account with a spouse, there are still things to consider to help save you some money. And if we could do that, then that's all part of the mission here. So thank you guys all for watching. I appreciate the time. If you have any questions on the capital gain, specifically how it might relate to your portfolio or some of your positions, please feel free to send us an email. Like I said, stay tuned for the other video I'm going to do, like the sister video for this, focusing on the tax loss harvesting and the carry forwards, as well as specifying tax lots and the wash sale rule. So stay tuned. Thank you all again for your time, and we look forward to seeing you on the next video.